we've just been discussing the Chinese interbank bond market and how foreign investors can gain access to that. We're now going to look at the future outlook for the deregulation of China's capital markets and what this all means for foreign investors. I'm here with Andy Eng, the head of HSBC Securities Services in China, and Sophia Chung, head of client services at HSBC Securities Services in China. Andy, you've been following this market for some time now. There's been a huge amount of change in the last few years and before that too. But what changes to the regulatory landscape do you expect to take place in 2013 and in the few years beyond that?
Thank you, Paul. In the year of 2013, we have already seen quite a few of the major initiatives happening in the first quarter, i.e. the first one would be the RQF scheme has been extended to cover basically all the FIs located in Hong Kong if they have the main business doing in Hong Kong and also Type 9 license in Hong Kong, investment license in Hong Kong. And also the CIBM, the People's Bank of China has promulgated the implementation details for the CIBM, the interbank bond market, and therefore make the QFI investing into the interbank bond market become practical. And also we have seen in the 2013, one of the major trend of development is to have this cross-border investment also expanded from institutional investors to retail investors, i.e. the regulators in China have now allowed Hong Kong, Macau, and Taiwan citizens living in mainland China to go investing into both the Asia market and offshore funds market as well. And also for the foreigners who are living in mainland China, they can now investing into the onshore domestic funds. Okay, so these are all the changes that we have seen in first quarter already in 2013. And going forward, I think there will be at least three major development we expect. The first one, as mentioned by our ex-CSRC chairman, Guo Shiqing, in January this year, the plan of CSRC is to make the inbound investment, the total size of the inbound investment equivalent to roughly about 10% of the total market cap, which currently stands about 3.6 or 3.7 trillion US dollar, which we all know inbound investment currently only accounts for roughly about 1%. So that means the RQF, QFI, CIBM, all this inbound investment can increase by another 8-9 times in the future. So this is the first major initiative that we expect to see going forward. And secondly, as I mentioned earlier, one of the shift would be having the changing from the move from the institutional investors to retail investors in this cross-border investment. And recently we have heard our new CSRC chairman saying that QDII2 is on their agenda. They are looking to allow retail investors to investing into overseas market without going any intermediate service provider, i.e. insurance houses, fund houses, broker dealers, but go directly into those markets. And the third initiatives that we expect to see, which has been widely reported in the market, is that the CSRC, the regulators in China, has been in discussion with Hong Kong MA on this fund distribution passport. That means one institutions, if approved by one regulators, when they're doing the fundraising in others market, they do not need to have another second round of approval.
So it's very, very exciting at the moment. Plenty of changes are taking place and there are plenty of opportunities for foreign investors. But Andy, to sum up, if you were an international portfolio investor wanting access to China, how would you go about that?
I think this liberalization simply provides a platform for the world coming into China and for China going to the world. If we look at the inbound investment part, we have QFI, we have CIBM, we have RQF, quite a different of regimes. So our investors, we need to know exactly what they want and then pick the right regime to apply for. Take the QFI, for instance. This applies to all the FIs. If you're eligible according to book, then you can apply. However, the concern for those wanting to go into QFI is that there's this asset allocation requirement by the regulator saying that you need to at least invest 50% of your portfolio into the equity. So for any FIs want to have both equities and bonds and do not mind having this asset allocation guidelines, then QFI would be the one that they should look after, look into. On the other hand, the CIBM part, CIBM is a market with a total outstanding of $4 trillion as at the end of last year. So if anyone who wants to go into this bond market without any exposure in the equity, then CIBM is definitely for those banks and insurers to consider. And lastly would be the RQV. RQV is more relaxed than QFI. They don't have any asset allocation requirement or restriction. However, the eligible entity can only be those FIs located in Hong Kong with the Type 9 asset management license in Hong Kong.
Andy, Sophia, thank you very much both for your time. That concludes our 4 chapters on the liberalisation of China's capital markets as part of our Connecting to Growth series with HSBC.